So, a warm welcome to today's webinar. Today is the 20th of December 2017. My name is Stefan Friedrichowski with a very complicated last name. Usual time, everything as usual. The only thing is it will be the last webinar for this year, but the good news is we will have the next one already starting in January, and you will find the two webinars maybe already on the webpage of JFD. But at least if you have an account at JFD, you will be notified by email as well. But anyhow, the next two topics, there will be one thing about Bitcoins, and maybe you have seen already that I have here one screen with Bitcoins. That will be an interesting stuff to talk about Bitcoins from a more statistical point of view. Because we can trade that and we can use well-known behavior, but we need some adjustments and we have to look more carefully to our trades when it comes to trading Bitcoins. But that's one announcement for next month, and the other one, we will change our perspective. That means let's think we are a broker, that you are a broker, and what kind of business model we will have them. So that's an interesting topic as well, and it will give you a deep insight into trading from the other side, so from the broker's perspective. Let's see. But anyhow, once again, a warm welcome, also in the name of JFD, the broker of choice here for our webinars and for our trading activities. As always, you can contact me directly here via email. You see my email address. I know I have a very complicated last name, so it's s.friedrichowski@jfdbrokers.com. And if you have any further questions, just get in touch with me via email. I hope I can help you further. And the other remark, you will find already the download as the slides from today's webinar. You can download them via the GoToWebinar control panel. So that's easy. That's an easy job. And so you have the slides. Later, we will have some additional Excel sheets. And if you have interest in those, just send me an email. You see the address, and I will make sure that you get all the Excel sheets as well. Today's topic: trade sequences Martingale. Okay, and the long term is that a profitable trading approach? But I use here the shortcut because otherwise it would not fit on the slides anymore later. So it's the second time that we talk about Martingale trading approaches. And normally everybody would say, hey, Martingale, that's devil's work. So you should not use anything like that for trading. And in principle, you are right. But there are ways to tame that kind of approach. And I think it was July when we talked first about those approaches. Yes, and we found a way to tame that approach. And just as a short start here, that's what we trade here. That's an account statement of one strategy. And I just want to show you that example because you will, during that webinar as well, you will hear statements like how to tame Martingale. So, and in this case, a few months ago, we looked carefully of how to introduce a stop loss into trading, and even what has been more important, to select the right underlyings for that kind of approach. That approach here is not really Martingale, it's more a grid approach. So it's a rebuy in case of losses. But we have a stop loss for the overall position. And as you can see here, and you know that I'm very transparent here with my accounts, that stop loss has been activated once during that period here. You see here. So that was a stop loss. And to have that kind of stop loss is simply to have not an unlimited risk for that kind of approach. And you see, it took 2 months to recover, and now everything is once again well. Strategy is running well, up to now 0.5% per month, but that will increase during the next couple of weeks because that deep step south is within that kind of calculation. So basic approach there has been we buy in case of losses, but not by doubling our position size, for example. No, it was a linear approach. So we buy with the same amount or the same position size. I repeat myself, the key was to look for underlyings which have not a quite well trendy behavior. So we need underlyings which more or less wiggle around. That was the past, and now we come to the next point, or how we can do another approach, and we will look exactly for the opposite underlyings. When I say opposite underlyings, I mean today we will look for those underlyings which show a strong trend behavior, or at least from time to time, or for a little bit longer period, so that they do not wiggle around as those on my previous slide here. So, of course, those underlyings will be related, for example, to Japanese yen, because that is a typical underlying which shows on short term a more trendy behavior, and that is key for today's webinar. What else? Yeah, as always, I have to show this slide at least once, and especially today, I think it's even more important. Because we talk about a risky approach, and maybe your final conclusion about that approach will, okay, nice to hear, nice to see how it works and how things can be set up in Excel to investigate such a strategy, but that's not mine. Okay, that's a conclusion, but others may think, why not? Let's see. But so here's a risk disclaimer. So when it finally comes to your own trading activities, of course, you do them for your own and by your own and on your own responsibility. So the topics of today that are that I make a short recap about the origin of Martingale approaches and how they normally would work. But it's just a short recap from July webinar. Will take a few minutes, but then everybody is up to speed to that kind of topic. Then we will do a first approach, but that will be done totally in a chart, and so that we get used to what I want to show here and how today's approach will work. Later then we come to the clue of how to tame today the Martingale approach. And the main aspect here will be that we apply risk-reward ratios bigger than 1. And you will see later that that will enable us to not double always our position and to get it much less aggressive. And so that will be the key element for that kind of Martingale approach. I will show you some profitable setups for underlyings here, and you see immediately, okay, that are different underlyings which really show that at least short-term trendy behavior. There are a few others we could add, but those are the one I will share here with you, and I will summarize all the parameters for that kind of trading activity. I will make a short outlook how that might work on H1 as well, because we will focus ourselves on D1 today. That I do everything here starting wise on D1 is simply because then those Excel sheets are more handy. I mean, we don't have that huge amount of data, and so then we can do everything a little bit easier. In principle, it works on with the same Excel sheets on H1. But then we have thousands, nearly 100,000 lines within that Excel sheet, and that's always a little bit tricky. So let's start with Martingale. What is the origin of Martingale? Originally, it stems from the roulette table, and I have to admit I'm not really familiar with the roulette table. I have visited a casino. How does it call? Casino. I don't know exactly the English name, but anyhow, I think you understand what I mean. Normally, what you do there, if you play Martingale roulette, you put money on red or black, and then you will either win or lose. The key is now, if you lose with the first round, then you double your pool. So if you start with, let's say, €1 and you would win, okay, then you would get an extra euro. But if you lose, then then you will double your pool. That means for the next round, you put €2 on the table, either red or black. If you think a little bit further, it does not really depend on what color you choose. You could always take the red one, and we will do it mathematically in a minute. But what does it mean? Always doubling. In case you finally win the next round, then you will recover all your losses previously. In case you win, then you go back to your original pool, so back to the €1 as the beginning. So that's all. That's a Martingale approach. If you lose, you double. That's the short summary of that approach. And nice anecdote, Casanova has been a gambler of that approach, and of course not very successful. But anyhow, let's see what happens if you do something like that. I have here just an Excel sheet which is simulating that kind of approach, and it's simulating. I will guide you because the naming here is in German, but anyhow, so we have a random number between 0 and 1, and that is this 0.85, for example, and then because I don't care here about the 0 on the roulette table, which has a different color. So I have a threshold of 0.5, which means in my case, if that random number between 0 and 1 is above that threshold, I have a loser. And if it's below, then I have a winner. That's all. Let's look here. So first round, the number is above the threshold, so I will lose. So I lose €5 in here. So I start with €200, then I go down to 195. Next round, I double my pool, means I put €10 on the table. Once again, a loser. I lose that, so it goes down by €10. Next, perfect. Double, but now I win and I get €20, so I will recover all the previous losses, and you see what happens. Finally, now let's look more from a trading perspective. Then we can calculate that equity here, and after 100 rounds, you see I have a steady increase of my account or my wallet here at the roulette table, and that's all. The downside is, of course, those deep dips here, like here. And the good thing for doing that kind of analysis with Excel is I can just randomize everything new. That means I just press F9 and I get a new sequence of trades or roulette rounds. You see what happened here? Oh, God. My account is ruined. That means I went through the 0 line. And I still could recover, no problem. But you see, I would need some extra money to put on the table because you see those red numbers here. I can recover, but I need more money. And now this time it's okay, and next time once again okay. Here ruin, but not that severe. But you see what happens. So in principle, it's a nice approach. We have a steady slope in our equity, but what's the but? Two buts. Mathematically, that means you need unlimited resources, so your wallet must be unlimited. One condition. Second condition, you need a roulette table without a limit. And that's, as far as I know, not typical, because there's always a limit, maybe €1,000, maybe 2,000, 10,000. I don't know those numbers. And those limits, will cancel your strategy, more or less. But on the other hand, you see what happens? Nice increase, very good slope of equity. And even the zero in the real life of roulette would not ruin here that approach, but the slope would be a little bit less. But the limits are the limits, and that is limited resources and the limit at the table. So that's the basics of Martingale. So just remember always, normally you double your pool if you lose, and that's all. We know that that kind of approach, let's do an intermediate conclusion here, is a guarantee to total bankruptcy. Okay, and still I have you here within my webinar. So how can we tame that? And to get an approach for trading which has a chance to generate profits as we like. And as I mentioned already, how to tame here is exactly not doubling every round, and we can do something from our normal trading activities, that we play around with the risk-reward ratio of a trade. Maybe right now you have a lot of question marks about that, but let's start in the chart in order to get a feeling of what I'm talking here about. And maybe one other pre-comment here, that kind of strategy has been developed, or the idea has been born on the WOT, the World of Trading, the trade fair in November in Frankfurt. Just talking to another trading guy, it's a visitor here from the German part of that webinar, and we talked in the evening about an approach. And honestly, it's most part is here his job, and I know he likes that I talk about that. So the basic idea stems from that guy called Martin, and let me show what we talk, and then later create a real strategy out of that. So let's start with a chart in order to get a real feeling for that strategy. Let's go here for Australian dollar, Japanese yen, and in order that not everybody is looking to the charts behind, let me enlarge everything. And now we have here a chart. Let's go for H1. And the original idea, Martin told me, he applies another strategy, which has also been discussed here during our webinars, and that is open range breakout strategies. We have a typical setup for euro, Japanese yen, for example, and how does it work? Normally, and don't take the numbers and ranges which I will draw here in that chart as given as a trading setup. No, it's just for illustration purpose only. Let's say we are at the end of that 8 o'clock candle here, and we apply a breakout strategy, meaning we place one order here and the other one let's say this one here is a range. And now you see we have a range and we place two orders, like in every open range breakout setup, a buy stop to the north and a sell stop to the south. Okay, later, and we will have a trigger for our trade, and that trigger would be to the north. And that would normally mean, okay, we delete, we cancel our sell stop order, and we now go in the expectation of a breakout, meaning the price went up. As the example here is perfect. That's the reason why I use exactly that. And let's say we have here our take profit. So that would be a risk reward ratio of about 1. And our trade 3-4 hours later would have reached our take profit level. Perfect. So we don't need any martingale or something like that. Everything went well. Open range breakout. We have a winner trade. We wait for the next day for the next open range breakout within the next day. Okay, everything went well with that trade. Let me manipulate a little bit my ranges so that I get a different example. Let's assume we place the lower line here, the upper line maybe a little bit down. Let's here, and that we start our approach already here. So that is the point in time when we place those two orders. Let's start here, from here. What does it mean? Now, after placing the order, a little bit later, my short trade would have been triggered. But finally, it does not went further south. And now the idea is, let's do this here a little bit higher, or maybe even a little bit lower. Let's go here. So we have been triggered here to the south, and already 2 hours later, our stop loss, which is always the opposite side of a range, would have been triggered. Okay, now we have lost 1R, one risk unit, or whatever lot size you use here. So we have a loser trade. And now let's think Martingale. What we would do is we would now not delete when the first trade has been triggered. We would not delete our buy stop order on the north side. No, we would have changed even that order to the double size. That would mean after we reach our stop loss here on the opposite side, our long trade would have been triggered, but now with a double risk. Okay, how does it went further? Easy. Take profit, still, let's say 1R distance. So our long trade would have been triggered, then went south against us, and once again now it went north, and finally we would hit our target value, our take profit value, and we would have recovered our first loser trade. Well, that looks already not that bad. So we could recover our loser in the second trial. So that's the basic idea here. By doubling the risk, still takes the take profit level as it has been, so 1R distance. But now, if we are in the second round, we have doubled, like in the original Martingale approach, our risk value, our amount of money we have on risk, and we could recover in the second round. Perfect. You may think, wow, that's great. Does it work always that good? No. Let's make a new example. Let me put a little bit the lines aside, that we see a little bit more what would happen if we have such an approach in a situation which is not that good. Let's go here. Let's start here, and let's think we would have placed, let's start, for example, here. Starting time, let's say, would be this line here. So here we start. We would place our two orders, our buy stop to the north, sell stop to the south, and that would be maybe that kind of open range breakout setup. You would see what happens. So we would have been triggered to the south here. A few hours later, our stop loss would have been reached. So we would change the direction of our trade to a long trade here. Our trade would be running until here. And once again, we would be in the stop loss. Now we would have to double once again our trade. So we would go south with a short trade. Unfortunately, once again, our trade would hit stop loss. We would have to double once again, and you see what happens. Stop loss here, doubling, here, doubling, 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 and finally, that trade would have reached take profit maybe around here. I have not counted exactly how often I said doubling, 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 but I think it was at least 5 times. Okay, that's still manageable if you start with a not too high value of original risk. But you can even think about even worse situations so that you have to double once again, once again, once again. The taming situation is now the following. Let's start with an Excel sheet that we know what I'm talking about here. Let's recap what we have up to now. So what we did up to now is we placed our take profit in 1R distance, so with a risk reward ratio of 1. And let's start with an original, just name that number size. You can think in lots or risk units. I don't care. It's just a number. So we start with 1. Then we have a loser. We have to double, and so on and so forth. So you see what happens if that would occur 21 times in a row. Then we would have to increase our amount of risk to already nearly 1 million. A disaster, complete disaster. Okay, on the other hand, you know that to be 21 times on the loser side will not happen that often, but to increase your risk to 1 million times, I think not everybody can survive that kind of situation. But anyhow, let's think a little bit earlier here. Maybe after 5 times we have a winner. Then you see we have to double. And now with the 5th trade here, we recover our account. That's great. But now let's do something different. Let's think about that we don't use a risk-reward ratio of 1. Let me go first back to into the chart. Let's assume that we take a risk-reward ratio of 2. So that we would place always our take profit the double distance of our range, like that red line here now. It would take a little bit longer until we would reach here exactly that kind of take profit level. But the good thing now is if we go for higher risk reward ratios, we don't have to double. And that's already incorporated into that Excel sheet here as well. And that is not the final Excel sheet for the trading. It's just for illustration purposes. You will see later we come with an Excel sheet with prices, historical data, and then we do that with real trades. Let's go for a risk-reward ratio of 2. The good thing is, in order to we cover, we don't have to double anymore our risk. To be more precise, we would need a factor of 1.5 in this case. Let's think back to our situation that the fifth trade now should be the winner one. So I just put a 1 here. Then you see we recover. We finally have in our account an earning of 2, exactly our risk-reward ratio. So all the losers before have been recovered. But now the difference is, after 5 trades, we are at a factor of 5. And not, as before, with a factor of 16. You see what happens? We don't need to increase our risk value by such a big factor like in the previous case. And even if I take out the winner here, let's go back to a loser sequence of 21 losers. From our original factor of 1 million, we now are down to 3,000. That's still a huge number, I know. But maybe we can go for risk-reward ratio of 3 or risk-reward ratio of 5. And then those numbers of our final risk value come down to levels which I think they are still doable in a real account. You may think, hey, is there a trick? No, absolutely no trick. It's what we do here is, because we need a higher risk-reward ratio, that enables us to not have a factor which is always doubling, but we buy, let's call it, let's say I buy that advantage by the fact that my final trade has a higher risk-reward ratio. And now let's go back to here and remember what I mentioned already in my introduction. What we need are underlyings which have, at least from time to time, more trendy behavior. The loser part of that kind of strategy are those sidewards phases. It's an absolute disaster for such kind of strategy. If after a sequence of losers, then we have real breakout, which is long-lasting and goes further into one direction, then we can recover all the losses before. And since we now, our final trade has a higher risk-reward ratio, and all the others would have had the same risk-reward ratio, but we never hit our take profit level. If we have finally a situation like here, then even a higher risk-reward ratio, and this would be about a risk-reward ratio of 5, just as a rough estimate here, we would have reached our target value, and we could recover all the losses before. So that's the real setup as discussed with Martin. So starting with an open range breakout, and then doing the risk adjustment not by doubling, just with a lower value, a smaller factor. And the formula is quite simple. It's just a 1 plus 1 divided by the risk-reward ratio. That's the complete formula how we have to calculate that kind of factor. Now I want to convert, to transform, or to incorporate that kind of logic into an Excel sheet so that we can have real price data and a real trading strategy. Now it becomes a little bit complicated because those range breakouts, for example, have a specific problem in managing in Excel, and especially managing sell stop and sell and sell stop and buy, no, sell stop and buy stop orders is a little bit tricky, because finally, when it comes here to candles, and we need those candles, I sometimes don't know what event has been first. So if I would place such a buy stop order, I can realize that in Excel as well. But maybe already the same candle is set huge that it would reach a stop loss value within the same candle as well. And now I get lost in Excel. And especially what I don't know is what event has been first, triggering the stop loss or triggering my buy stop trade, for example. So since I don't know what has been first, so I'm lost. The solution for that is going to smaller time frames. And then we definitely know what event has been first, but then we get extremely huge Excel sheets. So let's modify the strategy a little bit. And the modification is really simple. We don't talk anymore about open range breakouts. We just start a trade sequence. And with a trade sequence, what I mean is, okay, at some point within the chart, let's say here, with the open of that candle, we start a trade. And in order to be on the wrong side, I start a long trade. No breakout, we just start with the open of a candle, a trade. And let's think negative, and we open here a long trade. And let's assume we have a stop loss value, which is the other red line here. So only a few minutes later, a few candles later, our trade would have been in the stop loss here. So, and the stop loss would be already that candle here. And then what we do now is not placing a sell stop order directly at that level. No, we wait until the next candle. The next candle will be the open of our next trade. In this case, within that candle, our stop loss would have been reached, and the open of the next candle is here. What we do now is we open a short trade. That's good. But we apply the same rule of stop loss setting. So the distance of the stop loss for that trade is now here, a little bit higher. So the same distance like the first trade. And then it's up to us, where's our take profit level. So let's think we would have a take profit of about 2 times away from our range here. And then you see some hours later, we would have reached our take profit level. So the difference now is whenever a trade is opened, we open the trade with the open of a candle. That's the rule. We apply still the same logic of how far away is our stop loss. So that's still the same. But now our range, what has been previously static, is now moving around a little bit. That, by the way, sometimes even helps already. Like our entry of the second trade here would have been at a better position than just to have the other order already in place, the sell stop order to the south here. In this case here, we would have a better entry for the second trade. And now we reach already with the second trade our target. And in this case, the target would be 2 with a risk reward ratio of 2. So everything is now fine. Being now here, what happens next? We open immediately the next trade. Immediately means with the next candle. Let me put this line here. With the next candle, we open our next trade. And once again, since our trade before has been a short trade, now we open a long trade. And we play around with the same numbers. So we get a stop loss about this distance, and now about the red line here would be our take profit value. Unfortunately, we hit here the stop loss and so on and so forth. You see the logic? I hope so. So now let's summarize our setup and then translate everything to an Excel sheet which really generates trades. So the strategy runs the following. The trade is always entered with the open of the next candle. So we simply start somewhere in the chart or in the history. We open a trade with the open of a candle, just mark it. Our trade has a stop loss. We put it later in a certain distance, and in this case, we don't use, because we don't have a real range like open range breakouts with typical times and then price ranges. No, we just apply a multiple of an RTR, the average true range, and that gives us a value where to set our stop loss. And then multiple with a risk-reward ratio, we get our take profit. That's all. So both are calculated straightforward. Then, if our first trade is negative, then we increase the risk for the next trade. And by that kind of factor, I have to change to English, risk-reward ratio. And that's what we do. The next trade is opened with the open of the next candle. That's the rule. And we, once again, place a stop loss, we place our take profit, and so on and so forth. Finally, if the trade is positive, then our risk goes down to our original value. Let's call it 1. That's all. That's the strategy, and we can now look for such a strategy in a real Excel sheet. And you may know, I don't go in detail through the Excel sheet, just to guide you a little bit what happens here. So we have the price data here, then we calculate the average true range. In this case, I apply a period of 22 because of D1. Normally, when it goes to D1, I use exactly that ATR period, simply because that's a month. But you may take other values as well. And yeah, for this kind of strategy, we need a start value or start direction. In this case, it's -1 stands for short, but if I put that to 1, you see the overall equity, which is here in the left, doesn't really change. So it has not a huge impact when and how we start. What we use here, we calculate always the stop loss value as a multiple of our ATR, take profit for the trade. And then we always look, is it a stop loss or take profit reached within that candle or then the following candles. And just in case that both happens simultaneously within one candle, then we apply the worst case scenario that we always think the stop loss has been reached first. And finally, what we do here in the Excel sheet as well is we look for our risk unit. We start with 1, and then later we increase our risk if we have losers. And that is done by this formula, and we calculate the factor, and we apply that factor for the next trade. That's all. And now we have an equity here within Excel, and it's already not that bad, I would say. You may ask yourselves, what does it mean if here we have a number like 500? That's just the universal risk value, 1R, and you can translate that to any euro value just by multiplying with a typical risk you use for your trading. Let's say you would risk 100 euro per trade, then after that period of time, you would have earned 50,000 euro. So it's just multiplying the euro value for your risk to that number. You see what happens. Typically, everything is quite smooth and we get a good equity. And by the way, we are looking here for 17 years history of euro US dollar. So it's a long period, lots of trades. So it's 700 trades here. But what we see from time to time, we have those kind of dips, but they are not too heavy. Or what we can look here within the Excel sheet as well is what is our average multiplier we have here in place. And the average multiplier here is about 3. So most of the trades run with a multiple of 3R. So that's a typical risk. From time to time, we have to increase. But you will see that's not all. We can get it a little bit better here. So formally speaking, our strategy has 2 degrees of freedom. One is the stop loss distance as a multiple to the ATR, and the other one is the risk reward ratio for the trade itself. And those are the 2 parameters we can play around here, like in other strategies where you have different EMA values or whatever number you have, times for breakouts, and so on. Here we have 2 degrees of freedom, multiple for setting the stop loss as a multiple to the ATR, and the risk reward ratio of the trade itself. And let's change, for example, the numbers here from 1 to 1.3, and we get always a change in the equity. Everything is calculated. We may increase our risk-reward ratio here, and you see that our maximum multiplier went down, which is good. But we lose a little bit profitability. Maybe we increase that a little bit further. Okay. And we put the stop loss a little bit further away. Let's say, for example, here. And finally, we may have a strategy like this one here. So now our maximum factor for our risk is 17. And we have still a profitable equity, does not look that bad, and that's all. So how does it work in practice? In practice, it would mean we open a trade, we set a stop loss, we set a take profit, and then we wait. After that hour, when that trade has come to an end, if this take profit value has been reached, everything is fine. Just with the next candle, we open the next trade to the opposite direction, and still we have our original risk of 1. If the first trade has been a loser, in this case, we would have to multiply our original risk value with 1.4 about, and we go for the next trade in the opposite direction, starting with the next candle, with the open of the next candle. And that's all we do. That's the complete sequence of those kind of trades. To show you a little bit, if we have such an Excel sheet here, how can we optimize such a strategy? The good thing is if you finally use, for example, the real Microsoft Excel and not the LibreOffice like I do most of the time. But when it comes to optimization, I even switch to the Microsoft Excel, because here for LibreOffice, I would have to install Java, which I don't want to do. But let's switch here to the real Excel. And what you can do here, you can use a very nice formula, because what you can use is the so-called solver. And that solver tool, has a capability to optimize whatever. And to optimize whatever, of course, needs a parameter. And as always, for my strategies, I have that parameter opti which describes in summary the equity. The lower the value, the better. And you will see more details about in previous webinars where I introduced those key figures here. And then the solver is trying to minimize that value. And what it needs some other cells, and those are the two yellow one here, to manipulate, to change, and you give certain ranges for those cells, and then the rest is done by the computer itself. That's all. And then you get those parameters, and you can try that iteratively, because it's not a deterministic kind of solution for such a problem. So not every time the result is the same. That has some mathematical reasons here. I don't want to go in those details, but then you can end up with some values for your stop loss multiplier and your risk reward ratio. Since I invite you to put other underlyings into the table here, just one remark. Please don't forget to change the spread, because the spread has to be within those trades as well. And so don't, especially if you go for example, DAX, then you need definitely other numbers than for euro, US dollar. But you can see it's not the bad, not a worse strategy here. Maximum risk multiplier is about 9. We have a good equity slope, and not that huge drawdowns, so it works not that bad. And I mentioned that I will show you a few other underlyings, for example, euro, Japanese yen, to have another example here. And you see it works well here as well. Okay, let's Excel. And you see we get quite well equities here. Okay, here we have a little bit higher maximum risk multiplier. But on the other hand, the equity is quite straight, lots of trades, perfect. So next underlying, Australian dollar, Japanese yen. Here we have in average a risk multiplier of 1.8, which is really a low value. One time we have been at 12, but you see how it develops here. So that's an example for Australian dollar, Japanese yen. And I have all those numbers on a summary slide as well, so you don't have to write them down. But you can play around with those sheets as well. Let's look for another trendy underlying. And now we go for the DAX, or the price data here are from the FDAX. And you see an even better better equity here with less drawdowns, a higher slope. So drawdown here is only that we have a maximum factor of 25. So that we must have in mind when we apply those kind of strategies, that we are able, at least in this case once, to have a multiplier of 25. But this within 17 years. So it's a long period we have investigated with that kind of approach here. You can think even about smaller time frames, and I've done some work on that as well. Just that you see how it in principle can work. I put into the table here 3 years H1 of euro US dollar, and even that is not that bad. So the risk reward ratio is getting higher here, which is good, because then we don't have that huge value of highest risk factor. So in principle, it works for smaller time frames, but I know if you want to trade that kind of strategy manually, then H1 may be not the best choice because you'll have to be um, you have to trade in the night as well, so there's no time to sleep. So that would not be the best one. Only if you have an expert advisor, then that expert advisor can do the job as well. So you see, the logic of that strategy works. We can tame the risk a little bit, so we don't have to double anymore always our amount, like in the for the introductional case of the roulette table, with always doubling our risk. We can go to quite small numbers, like here in this case, that we increase our risk by a factor of 1.2 only, which is better. But this, I repeat myself, on the cost of that finally we need a trade which goes for more away with a longer distance for the take profit. So we have that higher final risk reward ratio of the trade. So that's, let's call it the downside. But if we have an underlying which from time to time goes really in one direction, that's perfect. That's our trade. And then we can recover the losses previously. Let me summarize a little bit what we have done here and how it really works. So we have a couple of setups here, and I have even one additional variant for the FDAX. I don't go into the details right now. It's more or less like whenever you start a new sequence, then you start that sequence always long. Why? Because we know that at least for last decades, the DAX has a bias, and that bias is always north. So whenever we start a new sequence, we start that sequence with a long trade. Even in case our previous winner trade has been a long trade as well. In between, we do short trades as well. But whenever it comes to a new sequence, then we open that sequence with a long trade. So that's the logic with FDAX long start. So let me summarize a little bit what we have done here today. We have, a couple of months ago, we have had already one strategy on not the same logic. It's really quite different because at that time it was more a rebuy strategy with a more grid approach, not doubling or even any factor of a lot size increase or a risk increase. So at that time, the taming has had two aspects. One, find the right underlyings, and the other one has been those rebuy activities. Now our taming is once again by finding the right underlyings, which are those which are exactly opposite to the previous selection. Now we want to have underlyings with a slightly trendy behavior. At least from time to time, they should move in one direction a little bit longer, because those are the one which generate our profits. So the taming here is today with, and once again, I have the German abbreviation for risk reward ratio of bigger than 1. But still, I have to mention it's risky, of course. But we can realize from our Excel sheet that those kind of approaches are quite profitable, so why not? And now it comes to that final sentence, because it offers the three ways of thinking finally about that kind of martingale approaches. Still, you can think and still you can think that martingale is always work of a devil, and you don't put your fingers on that. That's one possibility. The other one is you may think it can be an interesting variant for my own trading activities, but you have to know what you do. And just always doubling your, if you have a loser, then double your risk for the next one, is definitely not the right choice. So we know now how to tame that a little bit on the cost of higher risk reward ratios. And there may be even, let's call them the third people, the other ones, which at least realize that we know exactly what we do via Excel sheet. And if you come to that point, I'm always glad, because what I personally don't want is that anybody is entering the next trade just saying, that looks good, I go for that trade. No, what we need for trading is always we need an investigation of our basic idea of that kind of approach, not just saying, I go long euro US dollar because it looks quite well. No, that's not enough. We need a confirmation, and that confirmation we need out of the past, out of the history. And if we can say for our trading approach, our trading setup, that it has been at least profitable in the past, then we have one good argument to do those kind of trades. And that's what I recommend always in my webinars. Before we enter a trade, we should know that we have a statistical edge for that kind of approach. And only if we can prove that kind of edge, that kind of probability advantage, then we should trade. And that's how I do my trading, and that's how I always recommend going for the next trade, that we really know what we are doing. Yeah, that's for today. A little bit Martingale, a little bit Excel, and I hope you enjoyed that webinar as well. Once again, if you have interest in any slides, in the slides can be downloaded, but if you have forgotten to download, or if you want to have those Excel sheets, just send me an email. You see the email address here, s.friedrichowski@jftbrokers.com. Yeah, and before I really come to an end, because it's the last webinar for this year, I wish you a Merry Christmas and a Happy New Year when it comes to that. In 2 weeks from now, then it's already, we are already in the new year. I hope you will be back to our webinars next year. And as I announced already, it will start with change your perspective to the broker. And then we come to Bitcoins, an interesting topic as well. And it's really a hot topic. So enjoy your time, have a good time during the years, and yeah, bye-bye.